Every crisis begins in silence. 15 years after the chaos of 2008, the world's biggest banks are bracing for impact, quietly tightening lending, building cash buffers, and restructuring their defenses. They're not waiting for panic. They've seen how quickly liquidity can vanish, as it did when repo haircuts soared from 2% to 25% and Lehman fell overnight. But what are they fortifying against? And could these hidden moves shield us from the next shock, or only delay it? This is how banks are quietly preparing for the next financial crisis. Lehman Brothers entered September 2008, running on borrowed time. For years, its business model had relied on rolling over vast sums of short-term debt in the repurchase, or repo, market. Each night, Lehman pledged mortgage-backed securities and other assets to raise cash, promising to buy them back the next day. This cycle worked until trust began to erode. By late summer, counterparties started to question the value of Lehman's collateral. The solution on paper was simple: demand a bigger cushion or haircut on every deal. In practice, it was the start of a spiral. At the beginning of 2008, haircuts on Lehman's prime mortgage securities hovered around 2%. That meant for every $100 in collateral, Lehman could borrow $98. As the year unfolded, those numbers began to shift. By mid-September, haircuts had surged to 10%, then 15%, and in some cases, 25%, sometimes in a matter of days. Each increase forced Lehman to post more collateral or accept less cash, draining its liquidity at the worst possible moment. The repo market, usually an invisible engine of Wall Street, turned hostile. Lenders demanded higher haircuts not just on risky securities, but even on assets that had once been considered safe. Some counterparties began refusing to roll over repos altogether, fearing that a single misstep could leave them holding assets nobody wanted. For Lehman, this meant scrambling to find cash while watching its funding options disappear overnight. Behind closed doors, executives tracked the numbers with growing alarm. The firm's daily liquidity pool, once flush with tens of billions, dwindled rapidly. Credit default swap spreads on Lehman's debt soared, signaling that the market was betting on default. The cost to insure against Lehman's failure rose to record highs, feeding a vicious cycle. As confidence evaporated, so did the willingness of others to lend. On September 12th, the situation reached a breaking point. Lehman's ability to fund itself in the repo market collapsed. With haircuts at 25%, the firm could raise only a fraction of the cash it needed. That weekend, efforts to find a buyer failed. By Monday, September 15th, Lehman Brothers filed for bankruptcy, triggering the largest bankruptcy in U.S. history. The mechanics of the collapse were stark. When haircuts rise and funding vanishes, even giants can fall in a matter of days. The Lehman episode revealed a core vulnerability at the heart of modern banking, a reliance on short-term funding that can disappear almost instantly when trust breaks down. Terms like CDS, repo, and haircut entered the public vocabulary, not as abstract concepts, but as the gears that ground to a halt in full view of the world. Regulators responded to the chaos of 2008 with a sweeping rewrite of the banking rulebook. Basel III, finalized in 2010 and phased in over the next decade, set out to rebuild trust by forcing banks to hold more and better capital. The centerpiece was a new standard called Common Equity Tier 1, or CET1. Under Basel III, the largest banks must now keep a minimum CET1 ratio of 10.5%. Including capital conservation and countercyclical buffers. This isn't just a number on a spreadsheet. CET1 represents the highest quality capital, ordinary shares and retained earnings, that can absorb losses in a crisis. Alongside tougher capital rules, regulators introduced the Liquidity Coverage Ratio, or LCR. This measure requires banks to stockpile enough high-quality liquid assets, think government bonds and central bank reserves, to survive 30 days of severe stress without outside help. The logic: in a panic, cash is king, and only the most liquid assets will do. Banks worldwide had to overhaul their balance sheets, replacing riskier holdings with assets that could be sold quickly, even in a market freeze. JP Morgan Chase, the largest U.S. bank, became a poster child for this new approach. By 2024, its filings showed a CET1 ratio consistently above 13%, well above the regulatory floor. The bank's liquidity coverage ratio also topped 120%, reflecting a deep pool of treasuries and central bank deposits. This stockpile isn't just for show. During routine Federal Reserve stress tests, JP Morgan's models simulate dozens of crisis scenarios, including rapid deposit outflows, market shutdowns, and sovereign defaults. The bank's risk teams run these drills using advanced analytics, hunting for weak spots and recalibrating their playbooks with each new threat. These requirements are not uniform. While Basel III sets the global template, each region interprets the rules differently. Some countries have delayed full implementation or carved out exceptions, allowing room for regulatory arbitrage. Still, the broad effect is clear. Banks are now required to keep more of their own skin in the game, with capital and liquidity buffers large enough to weather shocks that once proved fatal. The new standards have changed daily operations. Banks must report their CET1 and LCR ratios quarterly, subject to close scrutiny from supervisors and investors alike. The cost of non-compliance is steep. Restrictions on dividends, bonuses, and, in extreme cases, forced restructuring. The memory of institutions like Lehman, undone by vanishing liquidity and wafer-thin capital, lingers in every regulatory filing and risk committee meeting. The rulebook has changed, but the underlying concern remains: how to ensure that when the next storm hits, the system holds. March 2023 brought a test of confidence that rippled through Europe's banking sector. Credit Suisse, one of Switzerland's most storied banks, found itself at the center of a storm that played out almost hour by hour. In the days after Silicon Valley Bank's collapse in the United States, rumors and headlines began to circulate about Credit Suisse's stability. By the middle of the week, clients were pulling funds at a pace not seen in decades. Internal reports noted outflows accelerating, with more than 110 billion Swiss francs leaving the bank in a matter of weeks. The pressure mounted as credit default swap spreads on Credit Suisse debt soared, making it clear that markets were betting against the bank's survival. On March 15th, the Swiss National Bank stepped in, announcing an emergency liquidity line. Credit Suisse drew 50 billion Swiss francs overnight, a number that underscored the severity of the situation. This was not a gradual bleed, but a run fueled by digital withdrawals and a sharp loss of trust. Each hour, relationship managers fielded frantic calls from clients, while executives monitored minute-by-minute liquidity dashboards. The bank's liquidity coverage ratio, once a point of regulatory pride, was now a source of anxiety. The emergency backstop bought Credit Suisse little time. Deposit flight continued, and by March 19th, Swiss authorities brokered a takeover by UBS, ending the bank's 167-year history as an independent institution. Meanwhile, Deutsche Bank in Frankfurt faced a different kind of test. As Credit Suisse unraveled, attention turned to other European giants. Deutsche's share price tumbled, and its credit default swap spiked, echoing the distress signals seen in Zurich. But the mechanics diverged. Deutsche Bank did not report material deposit outflows or tap emergency European central bank facilities. Its quarterly disclosures would later confirm that liquidity buffers remained intact, and the bank's capital ratios stayed within regulatory bounds. The market's fear was real, but the underlying numbers told a more stable story. The contrast between the two banks was stark. Credit Suisse's spiral was driven by a reputational run. Clients and counterparties, spooked by headlines and social media, moved with unprecedented speed. The 110 billion Swiss francs in outflows and the emergency 50 billion Swiss francs Swiss National Bank facility became symbols of a modern bank run, where confidence can collapse in days, not months. Deutsche Bank, despite market volatility and speculation, weathered the storm without resorting to extraordinary measures. The events of March 2023 revealed how fragile trust remains in European banking, and how quickly liquidity spirals can force even the most established names to the brink. China's banking sector is shaped by what isn't immediately visible. At the center of this uncertainty are local government financing vehicles, LGF-VS, entities created to fund projects that official budgets can't cover. Over time, these vehicles have accumulated debts that now rival the size of entire economies. The Bank for International Settlements estimates that more than $1 trillion in LGFV obligations will need to be rolled over in 2024 alone, a figure that highlights the scale of the challenge. LGFVs operate in a gray area, raising money through bonds and loans that often carry the implicit support of local governments, but without formal guarantees. This leaves risk lingering in the background. Regional banks, especially those outside China's major cities, have become the main lenders to LGFVs. Their fortunes are now tightly linked. LGFVs rely on new credit to keep projects moving, while banks depend on repayments to protect their own balance sheets. As China's economic growth slows and land sales, the backbone of local revenue, decline, doubts grow about whether LGFVs can continue to meet their obligations. The numbers are stark. By the end of 2023, BIS analysis put outstanding LGFV debt at nearly 60% of China's GDP. In some provinces, the debt tied to local governments now overshadows official budgets several times over. Much of this debt is short-term, requiring constant refinancing. In 2024, over $1 trillion in bonds and loans must be rolled over. This creates a maturity wall. If even a small portion can't be refinanced, defaults or forced asset sales could follow. For regional banks, this exposure represents a hidden fault line. Unlike the largest state-owned banks, which have broader portfolios and stronger ties to Beijing, city and rural lenders are often deeply connected to local governments and their financing arms. Their official loan books only tell part of the story. Off-balance sheet guarantees, trust products, and informal loans conceal the true extent of risk. When LGFVs falter, these banks see rising non-performing loans and sometimes face pressure to extend more credit just to keep projects afloat. The system's opacity makes it nearly impossible for outsiders to measure the real danger. Official data understates the scale of contingent liabilities. Analysts warn that a wave of LGFV defaults could start with regional banks and ripple outward. Regulators have responded by urging banks to increase provisions and tighten lending. But with so much debt coming due in 2024, the margin for error is razor thin. The question remains, can the system withstand a shock, or will these hidden liabilities force a reckoning? Bank of America began 2024 with a sharp reduction in new consumer loans. Internal filings show auto loan originations fell by 18% in the first half of the year, a rare contraction for one of the country's largest lenders. Credit card approvals also slowed, with the bank tightening standards and lowering available limits for new applicants. The shift wasn't limited to a single product line. Across mortgages, personal loans, and small business credit, origination volumes dropped as risk teams revisited assumptions about household balance sheets and future default rates. Executives described the move as a precaution. With economic growth slowing and unemployment trending upward, the focus shifted from expansion to preservation. Senior managers reviewed credit exposure by zip code, sector, and borrower profile, searching for early signs of stress. When delinquencies ticked higher in late spring, the response was swift. Pull back on new lending, raise minimum credit scores, and increase scrutiny on variable rate products. These decisions filtered through to local branches, where loan officers fielded more rejections and watched application pipelines shrink. The numbers tell their own story. In quarterly disclosures, Bank of America reported a 12% drop in total consumer loan balances, marking the steepest retrenchment since the aftermath of the global financial crisis. The bank's risk committee cited a need to conserve capital and maintain flexibility as economic forecasts darkened. By mid-year, internal targets for loan growth were quietly shelved, replaced by directives to prioritize liquidity and core deposits. For many households, this meant fewer options and higher hurdles. Applicants who might have qualified in 2022 now found themselves turned away or offered smaller lines of credit. The contraction rippled outward, slowing auto sales, dampening home purchases, and tightening cash flow for small businesses. The trade-off was clear. In the effort to shield the balance sheet from future shocks, access to credit for ordinary borrowers became collateral damage. HSBC's balance sheet tells a story of quiet transformation. In 2024, high-quality liquid assets, primarily government bonds and central bank reserves, accounted for 37% of total assets, a level that stands out even among global peers. This surge reflects a deliberate strategy. Over the last 2 years, HSBC shifted away from riskier lending and complex structured products, choosing instead to build a fortress of liquidity. Internal filings show a steady increase in holdings of UK gilts, US Treasuries, and top-rated Eurozone sovereigns, while exposure to corporate debt and lower-rated securities declined. This move wasn't just about meeting regulatory minimums. HSBC's Risk Committee, responding to both market volatility and lessons from recent crises, set internal targets well above the Basel III liquidity coverage ratio. By mid-2024, the bank's LCR consistently exceeded 140%, backed by a portfolio designed to withstand severe market shocks. The composition of these liquid assets is telling. More than half are unencumbered, meaning they can be sold or pledged at a moment's notice, and the bulk are denominated in currencies matching the bank's major funding sources. This alignment reduces the risk of currency mismatches during periods of stress. The bank's annual report details how this liquidity buildup affected overall strategy. Lending growth slowed, especially in less predictable markets, while treasury operations took on a larger share of the balance sheet. Analysts noted that HSBC's approach contrasted sharply with institutions still seeking yield through higher-risk assets. Instead, the bank prioritized resilience, accepting lower returns in exchange for flexibility. This trade-off is visible in the numbers. Net interest margins narrowed, but the cost of funding dropped as investors and depositors rewarded perceived safety. HSBC's liquidity fortification is more than a regulatory checkbox. It's a calculated response to a world where funding can evaporate overnight and confidence remains fragile. The result is a balance sheet structured to survive not just the next crisis, but the unknowns that follow. Collateral has become the silent currency of trust in modern banking. In 2025, the terms for secured funding are growing stricter across the board. Major banks are quietly reshuffling their collateral schedules, prioritizing assets that will hold up under scrutiny if markets seize again. The average margin requirement in repo transactions has climbed by 2 percentage points since last year, a subtle shift with outsized consequences. On paper, these changes look like prudent risk management. In practice, they carry a hidden cost. Every extra percentage point in margin means banks must lock away more of their highest quality securities just to maintain the same level of funding. That leaves less flexibility to respond if liquidity dries up elsewhere. The pressure is felt most acutely in the overnight and term repo markets, where even a small uptick in margin can force banks to reshuffle portfolios or scramble for eligible collateral on short notice. The mechanics are straightforward but unforgiving. When a lender demands more collateral for the same loan, a bank has to pledge additional government bonds or cash. These assets are then tied up, unavailable for other needs. The knock-on effect ripples through the system, tightening liquidity not just for one bank, but for all its counterparties. In the past, banks might have relied on rehypothecation, reusing collateral pledged by others, to ease the strain. Now, regulatory scrutiny and internal risk limits have curbed that flexibility. This discipline is not limited to the largest global banks. Regional and custody banks, too, are adjusting their collateral schedules, wary of being caught short if conditions worsen. The shift is visible in repo market data. Tri-party volumes remain steady, but the pool of unencumbered assets is shrinking. For borrowers, the message is clear. Access to secured funding comes at a higher price, and the margin for error is narrowing. In the effort to build a safer system, the cost of safety is quietly rising, 1 basis point at a time. Rising interest rates have delivered a direct and often brutal lesson to bank balance sheets. As central banks hiked policy rates from near zero to multi-decade highs, the value of banks' bond portfolios dropped sharply. 10-year U.S. Treasury yields, which hovered around 1.5% in early 2022, surged past 4.5% by late 2023. For banks holding large portfolios of fixed-rate securities, this created a painful accounting reality. Bonds purchased at low yields now traded at steep discounts, eroding the value of assets on hand. Under current accounting rules, these unrealized losses show up in the line item known as Accumulated Other Comprehensive Income, or AOCI. When yields rise, AOCI turns negative, reflecting the markdown in bond values. The numbers are staggering. By the end of 2023, U.S. banks reported more than $500 billion in unrealized losses on available-for-sale securities. For some regional lenders, these paper losses exceeded 15% of their total equity. Even if the bonds are held to maturity, the impact is real. Capital cushions shrink, and the ability to absorb future shocks is weakened. Duration sensitivity analysis reveals the mechanics behind the pressure. A 1 percentage point jump in the 10-year yield can slash the market value of a typical bank bond portfolio by as much as 8%. The longer the average maturity, the greater the hit. Banks with portfolios tilted toward long-dated treasuries and mortgage-backed securities felt the squeeze most acutely. Those that hedged interest rate risk or rotated into shorter maturities fared better, but few escaped unscathed. This valuation shock does not just affect regulatory ratios on paper. It limits flexibility. Banks facing capital pressure may be forced to raise fresh equity, cut dividends, or slow lending, all actions that ripple through the broader economy. The lesson is clear. In an era of volatile rates, the silent risk of bond portfolio markdowns can become a loud constraint, shaping every decision in the boardroom. Central banks are rewriting the rules of money, but the digital future brings new dangers. A retail central bank digital currency, or CBDC, promises instant government-backed payment rails, always available, always liquid. In theory, this should make the system safer. In practice, it introduces a risk that regulators have struggled to contain: the digital bank run. Traditional bank runs played out in lines at the branch, withdrawals limited by cash in the vault and the patience of depositors. With CBDCs, the scenario changes. Funds can move at the speed of code 24 hours a day with no physical bottleneck. In a moment of panic, millions could transfer deposits from commercial banks to central bank wallets in minutes, bypassing the old barriers that once slowed a crisis. Central banks have studied this risk in detail. The European Central Bank's digital euro proposal includes a hard cap, €3,000 per person. This isn't a technical afterthought, it's a deliberate circuit breaker. The ECB's own white papers warn that, without strict limits, a digital euro could drain deposits from banks during stress, amplifying instability rather than containing it. The cap is paired with tiered interest rates. Balances above the limit would earn less, or even face negative returns, making it costly to park large sums in digital wallets. The goal is clear: slow the migration, force depositors to think twice before fleeing en masse. Yet even with these breaks, the migration could be swift. Digital rails mean onboarding for pre-registered users is nearly instant. In a crisis, the difference between a contained outflow and a systemic run may hinge on how fast these caps are enforced and whether technical frictions hold up under pressure. Central banks debate whether to throttle transfers, impose emergency caps, or introduce delays. Each option carries legal and political risks. The analog run was measured in hours or days. The digital version could unfold in seconds. For banks, this is not a theoretical concern. Stress simulations by European regulators show that even with a €3,000 wallet cap, large numbers of depositors moving at once could still force banks to scramble for liquidity, especially regional lenders with high concentrations of uninsured funds. The digital run risk is no longer abstract. It is being modeled, debated, and quietly built into every new blueprint for the future of money. Liquidity stress is no longer confined to the walls of traditional banks. In June 2024, the digital asset world delivered its own stress test as a wave of redemptions hit the USD coin, or USDC stablecoin. Over the course of a single day, more than $6 billion worth of USDC was redeemed for US dollars, a volume that dwarfed many previous digital asset outflows. This was not a gradual withdrawal, but a rapid, concentrated exodus, triggered by mounting doubts over the safety of USDC's reserves after rumors swirled about one of its custodial banks facing regulatory scrutiny. On-chain logs captured the scale and speed of the event. Large holders, including trading firms and crypto exchanges, initiated redemptions almost simultaneously. Automated bots and arbitrageurs followed, accelerating the flow. Within hours, the circulating supply of USDC dropped by nearly 15%. Circle, the issuer, processed requests at a pace that rivaled some of the fastest digital bank runs in recent memory. The stablecoin's dollar peg wavered, briefly trading below $0.98 on major exchanges before stabilizing as redemption queues cleared. The mechanics behind this run revealed a new kind of liquidity risk. Unlike banks, stablecoin issuers do not face the same regulatory requirements for capital or liquidity buffers. Their reserves, often a mix of short-term treasuries, cash, and commercial paper, must be liquidated quickly to meet redemption demands. In this case, Circle tapped overnight repo markets and sold off government securities to raise the necessary cash. The process was orderly, but the underlying fragility was clear. If redemptions had continued, or if the market for government securities had frozen, the peg could have failed entirely, sending shockwaves through both crypto and traditional funding markets. This episode exposed the amplification effect that non-bank liquidity providers can have during periods of stress. As banks fortify their own defenses, the pressure can migrate outward, finding new weak points in the financial system. The USDC redemption wave was a warning. In the digital era, liquidity stress can erupt outside the regulated sector, bypassing old circuit breakers and testing the limits of market resilience. Commercial real estate has become a pressure point for bank balance sheets. Office property values have dropped sharply, with major indices showing an 18% decline from their 2022 peak. This isn't a paper loss tucked away in quarterly reports. It translates directly into shrinking collateral for loans already on the books. As leases expire and vacancy rates climb, appraisers are marking down building values, forcing banks to reassess the worth of the assets backing their commercial real estate portfolios. The impact is most acute in city centers, where remote work and higher borrowing costs have left entire floors empty. For regional banks, which often hold a larger share of their loans in local office and retail properties, the erosion in value is more than a statistical blip. Lower property valuations mean less collateral to secure existing loans and far less room to extend new credit. CRE indices now track a broad-based slump, not limited to one city or sector. Each percentage point lost in value chips away at the security cushion banks rely on, raising questions about the true resilience of their loan books if the downturn deepens. Consumer credit is slowing across nearly every major category. In the first half of 2025, new auto loan originations at the top 5 U.S. banks dropped by 21% compared to the same period last year. Credit card approvals are also down, with approval rates hitting their lowest point since 2012. Mortgage applications, already dampened by higher rates, have fallen further as banks tighten standards and raise minimum credit scores. For many households, this means the window to borrow is narrowing just as living costs remain stubbornly high. The strain is not limited to borrowers. On Wall Street, the job market has turned sharply. Challenger, Gray, and Christmas reported more than 30,000 layoffs in investment banking and securities trading through September 2025. The worst year for financial sector job cuts since the aftermath of the global financial crisis. Major institutions, including Goldman Sachs and Morgan Stanley, have announced multiple rounds of cuts, citing weak deal flow and declining fee income. As consumer demand for credit fades and banks pull back, the real economy feels the pinch. Fewer loans mean slower car sales, reduced home purchases, and shrinking payrolls in sectors that rely on discretionary spending. The squeeze is tightening from both sides, with households and banks each pulling back, amplifying the pressure on growth. Bond markets are flashing their own warnings. The ICE BofA investment grade spread, a key measure of risk pricing, has widened by 60 basis points since early summer, an abrupt move for what is usually a stable corner of finance. This kind of spread expansion means investors are demanding higher compensation to hold even the safest corporate debt, a sign that trust in the credit cycle is fading. Volatility is no longer isolated to riskier assets, it's seeping into the core of the market. UBS analysts now put the probability of a U.S. recession at 93%, based on their composite of income, consumption, and production data. These models, once dismissed as academic, have become dashboard indicators for traders and risk managers alike. As spreads widen and recession odds climb, the mood has shifted from cautious optimism to quiet alarm. The market's message is clear: risk is being repriced and the clock is ticking. In 2023, Credit Suisse drew on over 110 billion Swiss francs in emergency support, a figure that underscores how quickly trust can evaporate in today's interconnected system. Since 2008, banks have nearly doubled their average liquid asset ratios, cut U.S. consumer lending by double digits, and tightened collateral rules across global markets. Yet as of 2025, shadow debt in China tops $1 trillion in rollovers, and central bank reports confirm that digital currencies could accelerate deposit outflows in a crisis. Despite new buffers and regulatory reforms, the full risks of cross-border exposures and non-bank liquidity remain only partially visible. Many data points are either unpublished or classified. The facts show banks are stronger, but the system's weakest links are still shaped by hidden debt and fast-moving digital flows. History proves that crisis rarely arrives as expected. The evidence leaves one truth: preparation is visible, certainty never is.